In this video, we'll show you 3 top-rated growth stocks that could reward patient investors for years to come. These are businesses operating at the center of some of the world's biggest long-term trends, from cloud software and artificial intelligence to digital infrastructure and global commerce. By the end of this video, you'll understand why these companies have built powerful competitive advantages, what is driving their future growth, and why Wall Street continues to see significant long-term potential despite recent market volatility. The first stock is Datadog, ticker DDOG. When people think about cybersecurity, they often picture companies stopping hackers, but Datadog has quietly become much more than that. Its platform helps businesses monitor, secure, and optimize the cloud applications that power today's digital economy. Every time an online payment is processed, a streaming service loads instantly, or an AI application answers a user's question, there are thousands of moving pieces working behind the scenes. Companies cannot afford downtime, slow performance, or hidden vulnerabilities. Datadog exists to make sure those systems remain healthy, efficient, and secure. That is why this business has become increasingly important. Instead of offering just one security product, Datadog has created an integrated cloud observability and security platform that allows organizations to monitor virtually every aspect of their infrastructure from a single dashboard. Customers can monitor application performance, infrastructure health, network activity, digital user experience, logs, security threats, data quality, error tracking, and much more. The beauty of this model is that once customers begin using multiple Datadog products, switching becomes increasingly difficult. Every additional product strengthens customer relationships while increasing recurring revenue. That creates exactly the type of business investors love: a sticky platform, high recurring revenue, strong pricing power, and expanding customer spending over time. What makes Datadog particularly interesting is how quickly it has grown. The company's revenue growth has been nothing short of remarkable. Revenue tripled between its final full year as a private company in 2018 and its first full year as a publicly traded company in 2020. Even more impressive, revenue then expanded more than fivefold between 2020 and 2024. Very few software companies have managed that level of sustained expansion while continuing to attract enterprise customers around the world. Growth alone, however, is never enough. Eventually, investors want profits. Datadog crossed that milestone in 2023 when it generated its first full-year GAAP profit. Then the company followed that achievement with approximately 280% earnings growth during 2024, proving that management was capable of converting rapid sales growth into meaningful profitability. Although profits moderated during 2025 as the company continued investing heavily for future expansion, analysts generally expect earnings growth to strengthen again over the next 2 years as operating leverage improves. That combination is exactly what long-term investors often look for: a business that is still growing quickly while steadily becoming more profitable. One concern that briefly pressured the stock earlier this year involved artificial intelligence itself. Ironically, investors worried that AI models from companies developing advanced coding and automation tools might reduce the need for traditional cybersecurity platforms. For a while, that fear sent many cybersecurity stocks sharply lower, but something interesting happened. Instead of replacing cybersecurity platforms, businesses began demanding AI features inside those platforms. Companies wanted faster threat detection, smarter automation, better anomaly detection, more efficient monitoring. In other words, AI became another feature customers wanted rather than a replacement for the platforms they already trusted. That shift dramatically improved investor confidence. Analysts now generally believe artificial intelligence can enhance productivity in specific workflows without replacing comprehensive enterprise security platforms that organizations depend upon every day. And that plays directly into Datadog's strengths. The company already has deep relationships with thousands of enterprise customers. Adding AI-powered capabilities gives existing customers another reason to spend more while attracting entirely new customers looking for modern cloud monitoring solutions. That brings us to another powerful advantage: customer expansion. One reason software businesses can produce extraordinary long-term returns is because existing customers frequently increase spending every year. Datadog has repeatedly demonstrated this ability. As businesses migrate more workloads into the cloud, they typically add additional Datadog modules over time. An organization may initially purchase infrastructure monitoring. Months later, it adds application monitoring, then log management, then cloud security, then network monitoring, then data observability. Instead of constantly chasing new customers, the company can grow revenue from businesses already using its platform. That significantly improves economics over time. International expansion represents another meaningful opportunity. Cloud adoption continues accelerating globally, and many international markets remain underpenetrated compared to North America. As enterprises modernize their IT infrastructure, Datadog has the opportunity to establish itself as a standard platform across multiple regions. Analysts following the company continue pointing to three major growth engines: new customer acquisition, higher spending from existing customers, and expanding international penetration. Together, those drivers could support healthy double-digit revenue growth for years while profitability steadily improves. Wall Street certainly appears optimistic. The stock currently enjoys one of the strongest analyst support levels in the technology sector, with roughly 42 buy ratings compared with only a handful of hold and sell recommendations. That level of consensus reflects widespread confidence in the company's long-term business model. While the average analyst price target suggests only modest upside after the stock's strong rally, many analysts remain positive because they believe earnings growth can continue compounding over time rather than relying solely on multiple expansion. Of course, no investment is risk-free. Datadog trades at a premium valuation compared with many traditional software companies. That means expectations remain high. If cloud spending slows significantly, enterprise customers delay technology investments, or competition intensifies faster than expected, the stock could experience periods of volatility. Investors should also recognize that fast-growing software companies often experience sharp price swings even when the underlying business remains healthy. But sometimes volatility creates opportunity rather than danger. The companies capable of becoming dominant technology platforms rarely follow smooth paths higher. They often experience significant corrections before continuing their long-term growth story. For investors with patience, those periods can become attractive entry points. When you step back and look at the bigger picture, Datadog sits at the intersection of several powerful secular trends. Cloud computing continues expanding, artificial intelligence workloads continue increasing, cybersecurity remains a critical priority. Businesses continue generating more operational data every year. Every one of those trends increases demand for exactly the type of platform Datadog has spent years building. That does not guarantee future returns, but it does explain why so many analysts continue viewing Datadog as one of today's highest quality long-term growth stocks. Its business has already demonstrated exceptional execution. Its customer relationships continue deepening, its profitability continues improving, and its addressable market continues expanding. Those are characteristics that often separate temporary winners from businesses capable of compounding shareholder value for many years into the future. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. The second stock on the list is Smurfit Westrock, ticker symbol SW. At first glance, packaging might not sound like the most exciting investment theme in the market. It does not generate headlines like artificial intelligence. It does not attract the same attention as cloud software. And it certainly is not the type of business most investors immediately associate with high growth. But that is exactly why companies like Smurfit Westrock deserve a closer look. Behind every package delivered to your doorstep is an enormous global supply chain. Every online order, subscription box, electronics purchase, household item, or food shipment requires packaging that protects products while moving efficiently through warehouses, trucks, ships, and distribution centers. As e-commerce continues expanding around the world, the demand for high-quality, sustainable packaging keeps growing right alongside it. That places Smurfit Westrock in an attractive position for the long term. The company was created through the 2024 merger of Smurfit Kappa and Westrock, bringing together two industry leaders to form one of the world's largest paper-based packaging companies. Today, the combined business operates across approximately 40 countries, serving thousands of customers with consumer packaging, corrugated packaging, containerboard, paper products, and other industrial packaging solutions. Scale matters tremendously in this business. Larger operations allow the company to purchase raw materials more efficiently, optimize manufacturing capacity, improve transportation logistics, and better serve multinational customers across multiple continents. Those advantages become increasingly valuable during periods of economic uncertainty. A global footprint also gives Smurfit Westrock the flexibility to shift production closer to customer demand while reducing transportation costs and improving operational efficiency. That creates a competitive moat that smaller regional competitors struggle to replicate. Another major advantage comes from the company's exposure to long-term structural trends rather than temporary market cycles. Consumers continue shifting more purchases online, retailers continue investing in fulfillment centers, manufacturers continue optimizing supply chains. Every one of those trends increases demand for corrugated packaging. Unlike many industries that must predict future consumer preferences, Smurfit Westrock simply benefits whenever products need to move safely from warehouses to customers. The rise of e-commerce has fundamentally changed packaging demand. Years ago, products often traveled in bulk shipments directly to retail stores. Today, millions of individual packages are shipped directly to consumers every single day. That requires more corrugated boxes, better protective packaging, and increasingly sustainable materials. Those trends are expected to continue for years. Industry researchers project packaging demand to expand at an annual compound growth rate of roughly 3% to 4% through 2028, supported by continued growth in e-commerce and rising demand for environmentally friendly paper-based packaging solutions. Analysts also expect favorable long-term demand to extend well into the next decade. Kiplinger article referenced by the prompt. Sustainability adds another important layer to the investment story. Governments, corporations, and consumers are placing increasing emphasis on reducing plastic waste and improving recyclable packaging. Paper-based packaging has become an attractive alternative because it can often be recycled more easily while meeting changing environmental standards. That trend should provide another steady tailwind for companies with strong paper and corrugated packaging operations. One reason analysts remain optimistic is because Smurfit Westrock is positioned to benefit from both volume growth and operational efficiencies created by the merger. Whenever two large companies combine, management has opportunities to eliminate duplicate costs, optimize manufacturing facilities, negotiate better supplier contracts, and improve overall productivity. Those efficiencies can gradually expand profit margins over time. Investors are not simply betting on higher revenue. They are also betting on a stronger, more efficient company emerging after integration. Of course, mergers rarely happen without challenges. Bringing together two global organizations takes time. Different operating systems must be integrated, corporate cultures need to align, manufacturing operations require optimization. Those integration efforts can temporarily pressure financial results, and investors saw some of that earlier this year. Smurfit Westrock reported first-quarter results that fell short of expectations, reminding investors that large mergers often experience short-term growing pains before long-term benefits become fully visible. However, Wall Street largely looked beyond that temporary weakness. In fact, all 15 analysts covering the company currently rate the stock a buy, making it one of the few companies enjoying unanimous bullish ratings from the analyst community. Their average price target suggests roughly 24% upside over the coming year, reflecting confidence that earnings should recover as merger synergies continue to materialize. Kiplinger article referenced by the prompt. One reason for that optimism involves North America's containerboard market. Industry analysts believe supply and demand conditions are becoming increasingly balanced, creating a healthier pricing environment for leading producers. Disciplined capacity management across the industry could support stronger profitability over the coming years. Smurfit Westrock's leadership position allows it to capitalize on that improving environment. The company also serves customers across numerous industries: food and beverage, consumer products, healthcare, industrial manufacturing, retail, agriculture. That diversification helps reduce dependence on any single sector of the economy. Even during slower economic periods, essential goods continue moving through global supply chains, providing a relatively stable foundation for packaging demand. Income investors may appreciate another feature that often gets overlooked. Smurfit Westrock is not only focused on growth, it has also demonstrated a commitment to returning capital to shareholders. The company has increased its cash dividend for 14 consecutive years, earning recognition as one of the stronger dividend growth stories within the packaging sector. That combination of dividend growth and business expansion can become especially powerful over long investment horizons. As earnings increase, management has greater flexibility to continue rewarding shareholders while still investing in future growth initiatives. From a valuation perspective, many analysts believe the stock remains attractively priced relative to its long-term earnings potential. Unlike many technology companies trading at elevated multiples, Smurfit Westrock offers investors exposure to durable industrial growth without requiring extremely aggressive future assumptions. Sometimes the market places its highest valuations on businesses that are already widely recognized. Other times, opportunities emerge in companies quietly benefiting from long-term economic trends while receiving far less attention. Smurfit Westrock appears to fit into that second category. It may never dominate financial headlines. It may never become the most talked about stock on social media, but businesses built around essential infrastructure often generate substantial shareholder value over decades because they solve practical problems that continue growing year after year. As online commerce expands globally, packaging remains indispensable. As sustainability becomes increasingly important, recyclable paper products gain relevance. As supply chains become more sophisticated, large-scale providers become even more valuable. Those trends are unlikely to disappear anytime soon. That is why many long-term investors view Smurfit Westrock as more than just a traditional packaging company. They see a global infrastructure business quietly benefiting from powerful secular growth trends that could continue supporting revenue, earnings, dividends, and shareholder returns for many years to come. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on today's list is Arista Networks, ticker ANET. Artificial intelligence has become one of the biggest investment themes of this decade, but while most investors focus on the companies building AI models, there is another layer of the ecosystem that is just as important: the networks that move enormous amounts of data between servers. Without ultra-fast, highly reliable networking infrastructure, even the most powerful AI systems cannot perform efficiently. That is exactly where Arista Networks comes in. The company specializes in client-to-cloud networking solutions used by some of the world's largest data centers, cloud providers, and enterprise customers. Its products include high-speed Ethernet switches, its proprietary extensible operating system known as EOS, and CloudVision, a software platform that allows customers to manage and automate large-scale networks. These are not ordinary networking products. They are mission-critical infrastructure. Every time an AI model processes massive datasets, every time cloud applications communicate across multiple servers, and every time enterprises scale their digital operations, networking becomes one of the biggest performance bottlenecks. Arista helps solve that problem. That makes the company one of the biggest beneficiaries of the continued expansion of artificial intelligence infrastructure. One of Arista's greatest strengths is that it does not depend on a single customer or one isolated technology trend. Its networking solutions support cloud computing, enterprise digital transformation, hyperscale data centers, AI clusters, and next-generation networking architecture. As each of these markets expands, demand for faster and more intelligent networking continues growing. The company's software also creates an important competitive advantage. While hardware often attracts the attention, EOS has become one of the key reasons customers continue choosing Arista. Instead of managing thousands of network devices individually, customers can operate their entire network through one highly programmable operating system. That improves efficiency, it reduces downtime, it simplifies upgrades, and it makes the overall network easier to scale. Once organizations deploy EOS across thousands of networking devices, replacing it becomes both expensive and operationally risky. That creates another sticky customer relationship, and sticky customers often translate into recurring revenue opportunities for years. Artificial intelligence is creating another major growth catalyst. Training large language models requires enormous computing power. But increasingly, inference workloads, multimodal AI models, and autonomous AI agents require even greater networking performance because information must constantly move between GPUs, storage systems, and cloud infrastructure with extremely low latency. As AI becomes more widespread, networking becomes even more important. That is one reason Wall Street remains overwhelmingly bullish on Arista. Nearly every analyst covering the stock rates it a buy, making it one of the strongest consensus recommendations in the technology sector. Analysts believe the company's relationships with hyperscale cloud providers position it exceptionally well to benefit from continued AI infrastructure spending. Cloud service providers remain among Arista's largest customers. These organizations continue investing billions of dollars into expanding data center capacity to support artificial intelligence workloads. According to analysts, Arista's Cloud Titan business, which includes the largest cloud providers and hyperscalers, delivered approximately 30% revenue growth during 2025, matching the strong growth achieved the previous year. Meanwhile, the company's AI and specialty provider segment, which includes rapidly growing AI-focused cloud operators, Apple and Oracle, experienced approximately 49% revenue growth during 2025. Analysts expect both businesses to continue producing healthy mid-double-digit growth throughout 2026. Those numbers highlight something important. Artificial intelligence demand is no longer limited to one or two technology companies. Entire industries are investing aggressively in AI infrastructure. Every one of those investments requires faster networking, higher bandwidth, lower latency, and greater reliability. That creates a powerful long-term demand environment for Arista. Earlier this year, investors briefly became concerned after management issued cautious guidance for 2026. The market reacted negatively, sending shares lower, but several analysts argued that the pullback represented an opportunity rather than a warning sign. Their view was straightforward. The long-term demand drivers had not changed. Artificial intelligence infrastructure spending remained strong, customer relationships remained healthy, and Arista continued building one of the strongest order backlogs in its history. Temporary guidance adjustments rarely define the future of exceptional businesses. Instead, they often create opportunities for long-term investors willing to look beyond the next quarter. That perspective appears to have been correct. The stock has already climbed roughly 30% during 2026, yet Wall Street still believes there is additional upside over the coming year based on consensus price targets. What makes Arista especially attractive is that the company continues benefiting from several independent growth drivers at the same time. Cloud computing continues expanding, artificial intelligence adoption continues accelerating, enterprise networking continues modernizing, data center traffic continues exploding, digital transformation continues across virtually every industry. Few companies have exposure to so many secular trends simultaneously. Another important factor is execution. Technology trends alone are never enough. Management must consistently deliver products customers actually want. Arista has built a reputation for innovation, operational discipline, and customer satisfaction. That combination has allowed it to compete successfully in one of the most demanding technology markets. Of course, investors should also understand the risks. Large enterprise customers can occasionally delay infrastructure spending. Technology spending often moves in cycles. Competition remains intense, and because expectations for AI remain extremely high, even minor disappointments can create significant stock volatility. But those risks exist alongside enormous opportunities. Artificial intelligence is still in the early stages of transforming global business. Cloud infrastructure continues expanding, data volumes continue increasing every year, and networking requirements continue becoming more demanding. Those trends are unlikely to reverse anytime soon. For investors seeking exposure to the infrastructure powering artificial intelligence rather than simply the applications running on top of it, Arista Networks offers an interesting long-term opportunity. When we step back and compare all three companies featured today, something becomes clear. Datadog protects and monitors the software infrastructure powering the digital economy. Smurfit Westrock provides the packaging infrastructure supporting global commerce and e-commerce. Arista Networks builds the networking infrastructure, making artificial intelligence and cloud computing possible. Different industries, different business models, but each company operates in an area where demand continues growing year after year. Each has built competitive advantages that are difficult to replicate. Each benefits from powerful long-term trends that extend well beyond the next earnings report. And each continues receiving strong support from Wall Street analysts because of its ability to compound revenue and earnings over time. That does not mean these stocks will move higher every month. Markets never work that way. Even outstanding companies experience corrections, disappointing quarters, and periods when investors become overly pessimistic. The key is focusing on the long-term quality of the underlying business rather than short-term stock price movements. Patient investing has historically rewarded shareholders who own businesses capable of adapting, innovating, and expanding over many years. These three companies certainly appear to fit that description. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I would love to hear from you. Which of these three businesses do you believe has the strongest long-term competitive advantage? Datadog, Smurfit Westrock, or Arista Networks? And which one would you be most comfortable holding for the next 10 years? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.